Hello traders. Welcome back to another episode of NTRR. In today's video, we're exploring one of the most powerful techniques for intraday trading, combining multiple time frame analysis to achieve a clear and comprehensive chart analysis. From the daily chart for big picture context all the way down to the 1-minute chart for pinpointing precise trade entries, we'll break down each step to help you master this approach and apply it to your own trading. These concepts are versatile and can be adapted to any market, and they work just as well for swing trading as they do for day trading. By blending price action concepts across different time frames, we'll show you how to gain a sharper market perspective. We'll walk through a top-down analysis, moving from higher to lower time frames to pinpoint market direction, identify key supply and demand levels, spot liquidity zones, and uncover strong trading opportunities. So, if you're interested in learning more about an intraday multi-time frame analysis, please hit that like button to show your support, and don't forget to subscribe if you're new to our channel. Let's get into it. As part of our disclaimer, we use the NinjaTrader platform along with the NTRR Risk Reward Tool in our videos to manage our risk and rewards, demonstrating how we apply the concepts covered in each video to our intraday futures trading. The NTRR Risk Reward add-on for NinjaTrader was developed by us as a result of an actual need being traders, just like you, operating in the futures market, which led to NTRR becoming an authorized NinjaTrader add-on vendor for creating this tool. So what is a top-down analysis exactly? Top-down analysis is a method that combines insights from multiple time frames and market factors to build a well-rounded understanding of market conditions. By starting with higher time frames and then zooming into the finer details, we gain a clear view of market direction and key areas at each level. Now, a quick tip: starting from the daily time frame and piling on too many concepts or indicators can end up cluttering your chart by the time you reach your entry time frame, and that can be counterproductive. So don't do that. We prefer to keep our charts as clean as possible, focusing on pure price action, which often gives clearer insights and helps avoid analysis paralysis. In fact, the only indicator we use in our trading, except for the NTRR Risk Reward, is volume. In this video, we'll go over exactly what to look for in each time frame to help you make a smart, straightforward analysis of any chart. But first, why is it important to combine multiple time frames? Well, here are our main reasons. Reason number 1, overcoming directional confusion. Let's look at the MES contract on a 1-minute chart, which tracks the S&P 500 index. Here, the market seems choppy, with no clear direction. It keeps breaking structure levels both up and down, which can throw off any trader trying to read its moves. But when we zoom out to the 15-minute time frame, a clear picture of the trend emerges, showing a bullish pressure in the market. This section here on the 15-minute chart is the same choppy area we saw on the 1-minute chart. By understanding this higher time frame bias, we can confidently look for long entries on the 1-minute chart, aligning with the broader trend. If you are wondering what happened afterwards, the market made a normal pullback, allowing us to enter the market at a discounted price, after which the overall bullish direction continued. On the 1-minute chart, the low you see here has formed as a higher low following the previous pullback, signaling that the pullback has likely ended and the bullish trend is ready to resume. As a general rule, during a bullish market, we observe a series of higher highs and higher lows, while a bearish market is characterized by lower lows and lower highs. Next, we waited for a change of character to confirm that the short-term downtrend had ended. This confirmation came when the price broke above the previous lower high. Following this, we monitored the price for a pullback into this area, which had previously acted as both support and resistance, expecting it to now act as support again after the breakout. This confirmation occurred with the formation of 2 hammer candles, indicating that buyers were stepping in. The subsequent green bullish candle provided all the confirmation we needed to enter the trade. This entry method is commonly referred to as the break and retest strategy. However, we'll cover that concept in more detail in another video. Remember, if you're feeling confused about market direction and notice constant breaks of key levels, you're likely too focused on the wrong time frame. Stepping back to analyze the bigger picture can greatly improve your ability to make more precise and confident entries. Reason number 2, increasing accuracy. A small reaction at a higher time frame key level can actually signal a major trend change in the lower time frames. That's why, before placing a trade, It's crucial to check how close we are to higher time frame supply or demand zones. Doing this helps us set better targets and stops and avoid unnecessary losses. Let's analyze this example on the 1-minute chart. Here, we observe a strong bearish trend, marked by a sharp move to the downside immediately following the New York session open. This move breaks below the previous support level and leaves behind a valid order block along with a fair value gap above the broken support. If the price were to retest the broken support, turning it into resistance, or even push slightly higher to close the fair value gap and retest the unmitigated order block, this would present a high probability short setup. In this scenario, a limit order could be placed at the broken support level, with a stop loss positioned just above the order block, anticipating a continuation of the bearish trend. However, the market unexpectedly changes direction, disregarding both the support-turned-resistance level and the supply order block above it. But why? If we zoom out to the 1-hour time frame, we can see that this reversal aligns with a higher time frame recent support level that's been respected multiple times. By checking these key levels on the higher time frame, we could have avoided this risky setup. Reason number 3, optimizing trade entries. Using multiple time frames allows traders to pinpoint the best entry and exit points. For example, let's say you're waiting for the price to pull back to an order flow zone, ready to go long with the bullish momentum. If you place a buy order at the start of the zone, you may end up with a large stop. A more precise approach is to wait for confirmation on a lower time frame and enter at a better price, which helps to reduce risk, avoid false signals, and boost your confidence in the setup. Now that we've covered the importance of multi-time frame analysis, I'll show you the best way to combine multiple time frames for a well-informed, clear chart analysis. But before we jump in, if you're enjoying the video so far, please hit the like button to show your support and drop any questions in the comments below. Now, let me walk you through our top-down analysis technique, step by step. This process involves starting with a higher time frame and gradually scaling down to finer details to pinpoint the best trading opportunities. In our chart analysis, we focus on 3 main types of time frames, starting from the higher levels. First, we have the daily and 4-hour charts, which we use exclusively to identify key market structure levels on a higher time frame. On the daily time frame, we are only interested in current and previous days' high and low. Next, we use the 1-hour and 15-minute time frames for most of our analysis. This includes identifying market direction, supply and demand zones, order blocks, liquidity zones, and spotting trading opportunities. Finally, we turn to the 5-minute and 1-minute charts to fine-tune, spot reversal or continuation chart patterns and place our entries. Now, let's apply these concepts on a real chart with detailed examples to see this technique in action. Here, we're looking at the MES contract on the daily time frame. As you can see, the overall trend is bullish, but that doesn't mean there aren't red days in between. For us as day traders, each trading day is viewed independently, as today's market can easily turn out bullish or bearish, regardless of the broader trend. So, this is how our daily chart looks like just before the New York session open at 9:30 a.m. Eastern Time. Now, let's zoom in a little bit to see it better. In this daily time frame, our focus is on marking 4 key levels when we come to the market: the previous day's high, the previous day's low, and the current day's high and low, or current day's pre-market high and low in case you trade stocks instead of futures, which are traded almost 24 hours a day. We mark these levels because the most recent liquidity is often found around them, where the market recently deemed these levels as overbought or oversold. When the price approaches these levels, there's a higher chance of a reaction of some kind, making them valuable points to be aware of. Let's now focus on the 4-hour time frame, with the chart set to 9:30 a.m. Eastern Time. On this time frame, our priority is to identify and mark the most recent supply zone above the current price, specifically the area where the market previously shifted direction. Similarly, we mark the most recent support level below the current price, preferably a level that has acted as both support and resistance at different points. In addition, this area here can be marked as a support zone as well. Despite multiple attempts to break below it, as seen with these inverted hammer candles, the market failed to do so. Most recently, price has shown reactions to this level again, indicated by the formation of green and red hammer candles. These key levels are critical to highlight to ensure we avoid placing trades directly into high time frame zones where price is likely to react. For example, taking a short trade into a 4-hour support area or a long trade into a 4-hour resistance zone significantly increases the risk of failure. Always ensure there is sufficient room for your trade to move before price reaches one of these high time frame levels. Since the current price is near this support area, it indicates that we're not interested in taking short positions at this time. A short trade would only become viable if the price breaks decisively below this support level. Now, let's shift our focus to the 1-hour time frame. On this time frame, our primary goal is to identify and mark supply and demand zones, order blocks, liquidity zones, and fair value gaps. This is also where we plan our trading scenarios, determining where to engage with the market and how to respond in different situations. Let's start by identifying the supply and demand areas. These zones are key to understanding where buying or selling pressure is likely to emerge, helping us refine our trade entries and exits. Let's begin by identifying the 1-hour supply zones. The first notable zone is right here at the top, which aligns with the 4-hour supply area. Since we've already marked this level on the higher time frame, there's no need to duplicate it, as we won't consider taking long positions into a 4-hour supply zone. The second potential supply zone is represented by this green candle formed during the downtrend from the previous day. While this doesn't guarantee the market will fail to break through if today's session turns bullish, it's an area worth noting. If the price revisits this zone, we should monitor the price action closely for signs of resistance or continuation. Whether you choose to mark this level on your chart is a matter of personal preference. Lastly, we have a demand area here, which corresponds with the 4-hour support level we identified earlier. Since this zone is already marked on the higher time frame, there's no need to repeat it on the 1-hour chart. The only fair value gap with an unmitigated order block visible on this 1-hour chart is right here. If the market turns bullish today, there's a good chance it might attempt to retest this order block and fill the remaining fair value gap. This is because a significant amount of internal sell-side liquidity is concentrated within this zone, with many unfulfilled sell orders across the area. Now, let's outline our trading scenarios and determine how we will respond to potential market movements. But before we proceed, let me pose a question. What is the current market direction? Is it bullish, bearish, or simply ranging sideways with no clear momentum? Typically, we determine the immediate market direction on the 15-minute chart. But since we're planning our scenarios on this 1-hour time frame, I'm asking you to analyze it here. This is a tricky question, as there are multiple ways to interpret the market direction. Some of you might argue that the overall trend is bullish, and we're simply in a pullback phase before the next upward move. Others might suggest that the most recent direction is bearish, anticipating a continuation to the downside. Still, some may claim that the market is currently in a consolidation phase, moving sideways without a clear trend. So which one is correct? Well, none of them. As day traders, our primary focus is on today's market activity. We're not concerned with what the market did yesterday, last week, or even over the past month. Each trading day is independent. Even in a strongly bullish market, there will be bearish days, and vice versa. A bearish market will have bullish days too. So, let's assess what the market is doing today. Here's what we see. The market made a low, then created a high, followed by a pullback that potentially formed a higher low. After that, we had an internal high. Why do we call it an internal high? Because it hasn't broken above the previous high to establish a clear higher high yet. At the moment, the market appears to be pulling back again. Based on this, what is our directional bias for today? Currently, it's bullish, as the market hasn't broken and closed below the low we started analyzing from nor created a change of character. Our bias would only shift to bearish if the price breaks and closes below the previous day's low, the solid red line, which is close to today's current low and aligns with the bottom of the 4-hour support area. Now let's map out our scenarios and plan how to respond in each case. Scenario 1. From the New York session open, the market breaks and closes below the previous day's low. If this happens, our bias will shift to bearish. In this situation, we will wait for a pullback into the 4-hour support area, which should now act as resistance. Once the market retests this level, we will look for reversal patterns and confirmation through supporting candles. For example, an inverted hammer candle with higher volume than the preceding green candles on the 1-minute or 5-minute chart would signal that sellers are regaining control and the market is preparing to continue its move downward. Once confirmed, we can confidently enter a short position and target the next 4-hour support area, which is near the 58.30 level. This gives us a structured approach to capitalize on a bearish continuation. Scenario number 2. The market pulls back to the low of the day area and holds. In this case, since our bias is already bullish and we're positioned inside the 4-hour support level, our focus will shift to identifying continuation chart patterns on the 1-minute or 5-minute time frames. This could include patterns like higher lows, ascending triangles, or strong bullish candles with increasing volume. Upon confirmation, we'll enter a long position, aiming to take partial or full position at the high of the day if the trade offers at least a 1-to-2 risk-to-reward ratio from our entry. This cautious approach ensures we lock in profits, especially since the market could reverse from the high of the day and continue sideways, a scenario we aim to avoid, as trading in sideways markets is where most day traders lose money. Remember, you don't need to aim for a home run with every trade. Consistency is key. In fact, achieving a 1-to-2 risk-to-reward ratio with just a 40% win rate is enough to make you a profitable trader over time. Focus on disciplined execution and proper risk management rather than chasing large wins. But we'll dive deeper into that concept in another video. If the market breaks and holds above the high of the day after we've taken off 33% or 50% of our position, we'll aim to ride the remaining portion of the trade toward the 4-hour resistance level. This aligns with the likelihood of the market attempting to close the fair value gap and potentially retest the order block above. This approach balances profit-taking with the potential for larger moves. Scenario 3. The market breaks above the high of day. This scenario is similar to the previous one, but with a key difference. Instead of pulling back into the 4-hour support area, the market breaks above the high of day shortly after the New York session opens. In this case, our strategy will be to wait for the price to pull back to the broken high of day level, now expected to act as support. This is a critical level, as it previously acted as resistance when the price was trading below it. If the level holds as support, it presents an excellent opportunity to enter a long position. Our target in this scenario remains the 4-hour resistance level. Anticipating the market will aim to close the fair value gap. These 3 scenarios outline the only opportunities where we will engage in the market today. However, there are critical rules to follow for situations where the market moves differently. Number 1, the market breaks down to the 4-hour support area without pulling back first. We will not take a long position from the 4-hour support zone. Why? While this is a higher time frame support level, entering here would mean trading against today's dominant trend, which would be bearish at this point. Even though you may see a bullish reaction, sellers are likely to step in and drive the price back down toward the support level. Trading against the trend often results in unnecessary losses. Number 2, the market breaks up to the 4-hour resistance level without any pullback. Similarly, we will not take a short position from the 4-hour resistance zone. Why not? Because at this point, today's dominant market sentiment is bullish. Trading against this momentum is risky, as buyers are more likely to continue pushing prices higher rather than allowing the market to reverse from the resistance zone. By adhering to these guidelines, we ensure we are always trading in alignment with the current day's trend and sentiment, maximizing our chances of success. Switching to the 15-minute chart. On the 15-minute chart, we refine our analysis and make key decisions about today's market direction. Here's what we focus on. Number 1, determining the market direction. We assess whether the market is in a bullish, bearish, or neutral phase based on the most recent price action. Currently, it is bullish. Number 2, tracking breaks of structure. A break of structure occurs when the price breaks and closes above a previous high, indicating a continuation of a bullish market, or when the price closes below a previous low, signaling a continuation of a bearish market. Number 3, identifying changes of character. A change of character highlights a shift in market direction. For instance, transitioning from bullish to bearish or vice versa. This is a key signal that the market sentiment may be shifting. Number 4, spotting trading opportunities. We watch for price movements into our zones of interest, such as demand or supply areas, or fair value gaps. When the price approaches these zones, we prepare to drop down to the 1-minute chart to look for confirmation signals and execute our trades based on our prepared scenarios. Now that we've analyzed all the higher time frames and established our market bias, bullish or bearish, key levels we're watching, and our approach for each of the three scenarios, we're ready for the market to open. Since the market is approaching our area of interest, which in this case is the 4-hour support level, it's time to shift to the 1-minute chart for detailed observation. At this point, we closely monitor the price action to see how the market reacts to this critical level. Will it hold the support and give us a continuation setup, or will it break through and present a bearish opportunity? Let's dive in and see how the market unfolds. So, what did the market do after the open? It followed scenario 2 to perfection. First, the market retraced to the low of day and held this level, as evidenced by these candles. At this point, we patiently waited for volume confirmation, a noticeable increase in volume on a bullish candle, which we observed right here. However, the candle associated with this volume spike wasn't sufficiently bullish to meet our criteria, so we waited for additional confirmation. On the next candle, we got the confirmation we were looking for with this strong bullish candle, clearly indicating that buyers were stepping in. On the close of this bullish candle, we decided to enter the trade. But you might ask, why did we enter here without waiting for a change of character, which happens at this price level? Here's what we observed on the 5-minute chart just before entering the trade. A strong hammer candle closing near the low of day, signaling a clear rejection of lower prices and suggesting that buyers were stepping in. This hammer candle added an extra layer of confidence to our decision, reinforcing our analysis. Combined with the fact that we were trading at the 4-hour support level and following the plan outlined in scenario number 2, this confirmation aligned perfectly with our entry strategy. This multi-time frame confluence is what makes top-down analysis so effective in improving trade accuracy. Does this mean we could have been wrong? Absolutely. Being wrong is part of trading. No strategy or chart analysis guarantees a perfect outcome every time. However, as long as we adhere to our risk management rules and only take trades offering a minimum of a 1 to 2 risk-to-reward ratio, for instance, risking $100 to make $200, we can remain profitable over time. With this approach, we only need to be accurate 40% of the time to succeed. In fact, we could have chosen to exit the entire position at the high of day, securing just over 2x our risk in profit and wrapping up our trading day in about 20 minutes. This demonstrates the power of proper planning and disciplined execution, ensuring we capitalize on opportunities without overextending ourselves. So, traders, I hope this video brought you value and helped deepen your understanding of top-down analysis. If it did, please take a moment to hit the like button to show your support. It really helps the channel grow. If you're new here, subscribe so you don't miss out on future videos just like this one. Thanks for watching, and see you in the next one.